You know, there is an expression on Wall Street, which I remember from way back when. It's called climbing the wall of worry. That means there's always something to worry about, whether that be the bank crisis or inflation. Climb that wall of worry. David Stryzewski has come to New York to climb the wall of worry with us. You are worried about things, aren't you? You think that things are about to get real bad, don't you?
Yes, sir.
Make your case.
All right. So there's 5 primary things that move the markets. Now, the first one is that we've got inflation, we've got interest rates, what the Federal Reserve's doing about it, then corporate earnings and geopolitical events. So let me just set the backdrop here. So coming out of 2008, what did the Fed do? They reduced interest rates in a meaningful way. Then we pumped in quantitative easing 1, 2, and 3. This produced bubbles in the stock market, the bond market, the real estate market, and now the banking industry that we understand today. And so what has ultimately happened now is that the Fed has flipped everything as a result of inflation, and they were about 18 months late to the table. And so what's taken place here today is that if you raise rates 500 basis points, that's Richter scale-like activity. I mean, anyone who's refied a mortgage.
They haven't done that.
What's that?
Well, they've done that so far, but they're not going to do anything in the future.
Correct. So the challenge is the cost of capital today. And so this gets into the corporate earnings part. So we had prices go down last year. Now I'm expecting an earnings recession as a result of the cost of capital. If you couldn't make it borrowing at 3, 4, 5% rates, how are you going to make it at 7 and 10% rates? We're looking at office space right now as a massive bubble that is taking place here today. 70% of financing for the banks, for corporate earnings come from the banks here that are having all these challenges. So
you're climbing the wall of worry, but we ain't at the top yet. We can't see the other side where we can come down.
That's correct.
That's it. So what's the proportion of stocks versus bonds?
Okay, well, that's going to depend upon someone's risk tolerance, their time frame, et cetera. I think, though, if we understand cycles, you need to be a lot more protected today.
In bonds?
Well, I like treasuries, cash. I like growth-oriented fixed index annuities. I think that there's a wonderful opportunity for gold and silver to be made here today. If you look at the ratio of 83 ounces of silver for every 1 ounce of gold, when they can produce 9 ounces of silver for every 1 ounce of gold. And so that's a wonderful opportunity, if I can say that out loud.
So cash, treasuries, bonds, gold. That's you.
Buy everything when it goes on sale.
Okay. Mr. Stryzewski, climb that wall of worry and come back soon.
Thanks very much. It's coming.
All right. Looking at the movers.